The US Federal Reserve recently lowered interest rates, a decision that has garnered significant attention. This move, while anticipated by some financial analysts, has sent ripples through the global financial system, affecting markets worldwide. Rate cuts typically aim to stimulate economic activity by making borrowing more affordable. They make borrowing cheaper for individuals and businesses, encouraging spending and investment. However, they can also impact banks' profitability, at least in the short run, as lower interest rates can reduce the margins banks earn on loans. This particular rate cut comes at a time of significant uncertainty in the global economy, with many factors at play. Trade tensions and geopolitical risks are weighing heavily on growth prospects, creating a complex economic landscape. The Fed's decision reflects a cautious approach to navigating these challenges, aiming to provide some stability. It remains to be seen how effective this rate cut will be in bolstering the US economy, but it is a clear signal of the Fed's proactive stance. Moody's, a leading credit rating agency, has issued a stark warning about the initial negative impact on US banks due to changing economic conditions. Lower interest rates tend to squeeze banks' net interest margins, which is a critical measure of their profitability. This margin represents the difference between what banks earn on loans and what they pay on deposits, a fundamental aspect of their business model. Banks generate revenue from this spread, and a shrinking margin directly impacts their overall profitability, making it harder to sustain growth. This concern is particularly relevant in the current economic environment where uncertainty looms large. US banks have enjoyed a period of relatively high margins due to previous rate hikes, which bolstered their earnings. A reversal of this trend, with declining interest rates, could put significant pressure on their earnings and overall financial health. However, it's essential to remember that this is just one side of the coin and there are other factors at play. Long-term benefits, such as increased loan demand and economic growth, might outweigh these initial challenges, offering a more optimistic outlook for the future. If the Fed's rate cut does indeed spur economic growth, US banks stand to benefit in the long run. Increased economic activity typically translates into higher demand for loans. Businesses and consumers alike borrow more to invest and spend. This rise in loan demand can potentially offset the pressure on net interest margins. Moreover, a healthier economy generally leads to lower loan defaults, improving banks' asset quality. This positive feedback loop can ultimately strengthen the banking sector. Section 4. The RBI's dilemma: to cut or not to cut. This is a question that has been on the minds of many economists and policymakers. The US Fed's recent decision to adjust interest rates has sparked a global debate about whether the Reserve Bank of India, or RBI, will follow suit. The implications of such a move are far-reaching. India's economic landscape, you see, differs significantly from that of the US. The dynamics at play are unique and complex. While the US is grappling with slowing growth and potential recession fears, India faces its own set of challenges that are equally daunting. Inflation, for instance, remains a persistent concern in India. Rising prices affect the cost of living and can erode purchasing power. The RBI has a mandate to keep inflation in check, and rate cuts can potentially fuel inflationary pressures, making it a double-edged sword. However, the Indian economy has also shown signs of slowing down, with reduced consumer spending and a dip in manufacturing output. This presents the RBI with a difficult balancing act. They must weigh the benefits of stimulating growth against the risks of exacerbating inflation. The decision is far from straightforward. Section 5. Rate cuts in India: navigating the initial hurdles. Should the RBI decide to cut rates, Indian banks might face initial challenges similar to those of their US counterparts. Lower interest rates would likely compress their net interest margins. This could be particularly challenging for banks already grappling with high levels of non-performing assets. Furthermore, a rate cut might not immediately translate into increased credit demand in India. Factors such as weak consumer sentiment and investment uncertainty could dampen the impact of lower borrowing costs. The RBI will need to carefully consider these factors before making a decision. Section 6. A brighter outlook: the potential for Indian banks. Despite the initial challenges, a rate cut by the RBI holds the potential for long-term benefits for Indian banks. Lower interest rates could eventually stimulate credit growth. As businesses gain confidence, they are more likely to invest and expand, boosting loan demand. Moreover, rate cuts can help improve asset quality in the long run. They reduce the debt burden on borrowers, making it easier for them to repay loans. This can lead to a decline in non-performing assets, strengthening the financial health of Indian banks.